Well, U.S. markets were able to stop the bleeding today, but that was about it. The S&P 500 was able to kind of hold the line, and we still are trading above the levels of where we were trading 10 days ago on that really ugly Monday. However, on the flip side, the Russell 2000 small cap index did breach their lows, and we are now trading at 6-month lows on that small cap index. So that's not a great sign there. You would have expected a much bigger pop higher out of the markets today if the bulls were comfortable with the valuations they were seeing after prices have gone on sale here recently. So I looked at today's move as a little bit of a fizzle more than anything else, and our bearish posture is retained across the board with all 4 indices. So we'll take a look at all of that. We'll then get into our trade application example on one of the world's largest companies that did revert back to a bearish posture today to see if we can place a bearish trade there. So with that, let's go ahead and get started. Welcome to the Market Outlook video presented by MarketScholars.com. I'm your host, Brandon Van Zee. It's August 15th, 2019. First of all, if you're new, welcome aboard. Remember to go to YouTube, click subscribe. While you're over there, check out our description area where you can sign up for our email distribution list. We're also heavy users of Twitter. Feel free to follow me at Brandon Van Zee. Also, we appreciate those of you that go out of your way to click like and retweet of these Market Outlook related posts if you want to send David and I the message that you want to see these continued on a daily basis. Lastly, we do have a presence on Facebook as well, and you can see the web address embedded in the logo in front of you. All right, let's go ahead and dive into the charts. As you can see, I've got chart 4B pulled up here in front of us. As a reminder, this is just our 4 grid to look at the 4 major U.S. equity indices, so that way we can see if there's any sort of differences between them or whether they're all kind of looking the same. Well, as I mentioned in the intro, we do have 2 of our indices that were actually up today. So the S&P 500 was up 0.25% today. Dow Jones was up 0.39% today. That was actually somewhat impressive considering what happened to Cisco. Then again, Walmart had a massive move higher here today off of their earnings announcement, and Walmart is the higher price stock compared to Cisco and therefore more important in the Dow Jones Industrial's eyes. So that likely accounts for why the Dow Jones was able to make that move. I've also noticed that a stock like a Coca-Cola has been holding up reasonably well despite the market turmoil here recently. Now on the flip side, down below here, you did see that the NASDAQ was down just barely, down 0.09% here today. Again, part of that was due to Cisco. And then over here on the right-hand side, on the lower portion, we have the Russell 2000. Notice that it was down 0.40% here today. So despite what a lot of people felt like was a little bit of a bounce back for the market, the Russell 2000 just continues to struggle. And as you can see right here, it did put in a brand new low. We were breaching not only yesterday's lows, but of course these lows back here at the end of May as well. So small caps do not look very strong here, at least in the United States. Part of the reason behind that, there are a lot of financial companies in the small cap index. In fact, we talked about one of them today in my question and answer session. For those of you that are premium members of Market Scholars, if you're interested in my thoughts on First Interstate Bank, amongst a lot of other stocks that we talked about, that recording is now posted on our calendar, so feel free to go back and check that out. Remember that that is time-stamped once you go into it on our calendar. But anyway, the Russell 2000 does have a whole bunch of small cap financial stocks in there. It's a bigger weighting towards the financials than you'll see in a lot of other indices. And with the inverted yield curve that everybody was talking about yesterday and just falling interest rates in general, this is a market environment where small cap banks are not really working so well. And so I think that is causing a little bit of extra concern there for some of the Russell 2000 followers out there. As you can see, it remains in a bear market across the board. Now that was as of yesterday. We already had the bear market across the board, but today was a continuation of that despite the bounce in the S&P 500 and the Dow Jones. Notice the background colors of both of those are pink, just like down below. The NASDAQ and the Russell 2000 are pink. Now, keep in mind that postures do change. That's the whole point of us doing these videos on a daily basis. So it is possible that any random tweet could come out tomorrow and send the stock market rocketing higher yet again. And we have seen more whipsaw here recently than we have in other periods. Notice that, for instance, on the S&P 500, we had a nice steady bullish posture during this entire time from June 6th all the way up here till August 1st. After that, we went from green to pink. We then went up to green again here after the market had a little pop higher, but as of yesterday, we went back to pink. So we have been kind of going back and forth. And remember, this is not David and I's sentiment. We're not saying, well, here's what we think. You know, we can't stare into a crystal ball any more than you guys can. We're basically just reading what the technical indicator is telling us. And to catch everybody else up to speed, the technical indicator that we're using here is the market forecast technical indicator. You can find that on the Thinkorswim platform or other TD Ameritrade related resources. But it's a technical indicator like there are hundreds of other technical indicators out there. And so it's going to use past information to give you insight about how to set your expectations for the future. Now, if the past information that's being loaded into that technical indicator has proven to be choppy, then that's what your results are going to be as well. So, you know, keep that in the back of your mind. We're all looking for the nice trends, whether they're all trending up or whether they're all trending down. You can make good money in those environments. But when things start chopping sideways, where you get more of this kind of W type of a pattern here, things get a little bit more dicey. And that's an environment, by the way, where swing traders might do a little bit better. We've been on a really good hot streak in my swing trading class that I conduct on Wednesdays for my Market Scholars Premium clients. We've won the vast majority of our trades. I would guess that out of the last 10 swing trades we've done, we've only lost one of them. So it's truly exceptional. Usually we would expect our win-loss ratio to be closer to 50%, but we've actually been doing quite well recently, and I think part of the reason behind that is because of the market environment, because of that chop and slop. What we try to do in that class is we try to buy bounces, and we also try to sell bounces down. So buy bounces up, sell bounces down. It's not a trend trading approach. It's an approach where you're looking for pullbacks, and once stocks are bouncing higher off of those support areas, then we're buying them for a swing trade only to be in them for a couple of days or a couple of weeks. So, you know, the more nimble you've been in this market environment here over the last, let's call it 3-4 weeks, probably the better off your results have been. If you're more of the mindset of the trend trader or the buy and hold investor, you've struggled a bit more just simply because you haven't had a whole lot of upward price action to get excited about. So do keep that in the back of your mind as well. One other thing I wanted to point out before we advance our slides here or advance our charts is that we do have what's known as a cluster signal. This is an oversold cluster signal here on the Russell 2000. Now keep in mind, from all the research that I've done, the bullish clusters, or in this case what we call the oversold clusters, do have a better hit rate than the overbought clusters. Remember, the overbought clusters would show up as red dots on the chart above the price action. We don't have any on these charts here for me to show you, but that's what it would look like. It's the opposite of what we're seeing right now. Now, when we get a cluster, it basically, let me right click and go to maximize sell so you guys can see this a little bit better. Here's the green dot I'm referring to. It's directly below today's candle. Here's the green dot down below that corresponds with it, and it's a visual representation of the fact that we do have the green line, the blue line, and the red line all in the lower reversal zone on the same day. Now, what that tells us is that things have gone a little bit too far too fast in whatever direction it's going. In this case, clearly the direction is down. Now, that does not mean that you get an immediate reversal higher, and it most certainly does not mean that it's going to reverse the trend that it finds itself in. The way that I tend to think about it is, whatever condition the market was in to get it into this cluster will not continue in the near term. Now, that's not a guarantee either, but that's at least how I set my expectations. So in other words, you know, if we just went down in a straight line from 1600 down here to 1450, then my expectation is that we're not going to go down in another 150 points here on the Russell 2000 in the same amount of time in the next month. So what that could mean as a result is that, you know, the Russell 2000 could bounce higher, it could go sideways, or it could continue to go lower, just not at the same pace that it was in to get it into that condition to begin with. So keep that in the back of your mind, because sometimes people want to, you know, look for that holy grail of sorts and say, well, geez, I found this one thing that's going to ensure that I have success with my trades. And of course, that doesn't exist. There is no holy grail in the world of trading. However, I will say that the last couple of times we received clusters, as you can see over here on the Russell 2000, were actually good times to be counter trend. In other words, the idea that we went down too far too fast right here into the end of May, if you were buying on either of these two candles here, you got a really nice rip higher. Now, it didn't push the Russell 2000 into some big uptrend. Remember, we've been dealing on the Russell 2000, if we want to look at a one-year chart here, with basically sideways price action here over the last year. So that's not what it did. What it did was it reverted us back towards the mean. And that is enough for you to make some decent money on if you're on the right side of the trade. So whether that happens again now that we're starting to produce these clusters is anybody's guess. But what it could also mean is those of you that have been fortunate enough to be bearish on the Russell 2000 for the last, let's call it 3 or 4 weeks, you might want to start reducing your risk on the bearish side of the coin. The big portion of that gain has likely been made, and there is a decent chance that a reversion to the mean type of a bounce could occur, at some point here in the near term. All right, let's go ahead and take a look at our next chart setup. This one will be our 3 green arrows chart setup. All right, so as we're looking at this, it is 3 red arrows across the board. We know that because of the background colors of the charts. So when we're looking at that particular chart right there, it's red right there, it's red right there, and it's red right there. Now, in addition to that, all of the moving averages are also red. Remember, those are technically 2 different things. The moving average will tell us if price is below a falling moving average. If that's the case, then it will be a red moving average, which it is. The background color of the chart will tell us something slightly different, which is, do we have a 3 red arrows conditions in place on that particular chart? And the 3 red arrows that we're referring to are a way to read the chart from 3 different technical indicators perspective. The first technical indicator is the moving average. In this case, we use a 30-day moving average. Down below, we use a MACD histogram, and then down below that, we use a stochastics reading. And so all 3 of those have what we refer to as red arrows. So there's red arrow number 1 on the S&P 500, there's red arrow number 2 on the MACD, and the most recent red arrow is right down there on the stochastics. So we have a 3 red arrows condition that exists right now on all 4 of our charts right here. Now, typically, the way that we use the 3 red arrows or the 3 green arrows is in trend trading capabilities. And so those of you that are looking for trend trades right now, this is suggesting that the trend that is a little bit better to identify at this moment in time is the bearish trend. Whereas, back here earlier in the summer, the trend that was the better one to focus on was the bullish trend. So, again, when we have choppier markets, that can change relatively quickly. So sometimes you will be, in on the wrong time and in the wrong place and so on and so forth. But it is one way to read the chart. So right now it's telling us, hey, if you're trying to look for trend trade setups, right now the conditions are not ideal unless you're looking for those bearish trades. All right, looking now at our next chart setup. This will be our 1040 crossover method here. And as I mentioned to you on Tuesday, the only one where we have an issue is, of course, the Russell 2000. And that was not helped along since I was with you on Tuesday. Of course, yesterday was a massacre in the market, and today the Russell 2000 continued lower by 0.40%, like I mentioned before. So it hasn't been doing itself any favors. Now note that the price action on the other 3 charts is not all that attractive either. In fact, it's worth pointing out that the Dow Jones Industrial Average, the price, is now trading below the 40-week moving average. Some of you that use daily candle charts will recognize that that's equivalent is a 200-day moving average. A lot of times people look at the 200-day moving average as kind of a way to think in terms of longer-term performance. So it's not a great sign when you see prices below the 200-day moving average, because as you can see back here, price bounce off the moving average, price bounce off the moving average, price bounce off the moving average. Many, many times, price came down to that blue line, bounced off of it. Now, here was an exception where we breached it and we stayed below it for a longer period of time, but, as we all know, through the benefit of looking through the rearview mirror, we eventually bounced back and things were not so bad. But remember, eventually, if there is a prolonged bear market, it will start with a crossover of those moving averages. We don't have the crossover of the moving averages yet on the Dow Jones, but we do have price below the 40-week moving average, aka the 200-day moving average. And so that's the beginning of that possibility. doesn't mean that it has to happen. It just means that if there is going to be a crossover of the moving average, then the prices have to stay below the moving averages themselves for a fairly good amount of time. And right now, that is where we find ourselves. Now, of course, this is Thursday. Tomorrow is Friday, and the way that markets have been moving here in recent weeks, who knows? Maybe this thing flies higher tomorrow. But as of this moment in time, that's not a great sign there. Now, the background color remains green because, according to that crossover system, it's still bullish. But those are our early warning signs that perhaps, the winds are a-changing, and doesn't help that the Russell 2000 has already changed and has given us that bearish crossover there, and that continues to be the case right now. Let's go ahead and take a look at our next chart setup. And this one will be chart 4E, and this is our 12 grid analysis. Remember, on the 12 grids here, we're going to be looking at the background colors to tell us whether we have a bullish or bearish intermediate term posture. So remember, there's several different postures within the market forecast itself. The green line is the one that we focus on mostly during this presentation. And so I just want to reiterate that is the case here. So when we're looking at this first set of 12 grids on chart 4E, this is our intermarket analysis 12 grid. One of the things that did catch my eye today is that the dollar continues to bounce. Boom, boom, boom. All the way up to the upside, bouncing off of that upward trending moving average right there. Now, despite the strength in the dollar, gold has not really pulled back. Gold is being used as a relative safe haven right now. It's not really being viewed as a commodity per se. Notice that gold has been up 2 out of the last 3 days and 3 out of the last 4 days. Gold is very close to a multi-month high. Gold is performing quite well. Gold is oftentimes viewed as a place to kind of hide out when markets get chaotic, and it is kind of showing its stripes from that perspective right now. Whereas other more traditional commodities, like your ag commodities, are just completely imploding here in front of us. And we also have crude oil that, while it's not down as bad as the ag commodities, it's not really going up the way that you want if you want to be bullish on the overall markets, as taking a temperature of risk out there. Crude oil has been down for the last couple of days. Not only that, but it's bouncing lower off of that falling moving average. So while the posture of crude oil right now is bullish because the intermediate line is at 43 and rising, I wouldn't say that the price action is doing it any favors right now. And remember, there are different ways to look at charts. So right now, I'd be a little bit more cautious, I think, around crude oil, unless you expect the risk-on environment to return relatively quickly here. Some of the other charts that we've been looking at lately, me and my broken record, are going to mention BNDX yet again. In fact, today was one of its best days on the entire board. I come into these presentations every Tuesday and Thursday, letting you know that, yes, foreign bond market is the place to be. No, it is not exciting, but it is a great place to be making money right now. And it continues to be the case. BNDX was up another 0.63% today, and that is about as perfect of a trend as you're ever going to see on a chart. Very few pullbacks along the way. We had the one pullback right there where we had 4 days in a row to the downside, but even that did not breach that upward trending 30-day moving average. I mean, this thing hasn't even touched its 30-day moving average in over 3 months. It's remarkable. Most charts will not do that. So if you ever are fortunate enough to latch onto one of those that does, you're in a very, very solid position. So foreign bond market continues to work. U.S. government bond market also working reasonably well. Notice that TLT was up another 1.1% today, and of course that means the flip side. Interest rates fell yet again today. TNX up here fell another 52 cents. Or percentage points or basis points, however you want to say that. But point is, if you move that decimal point over to the left once, you'll know that right now the 10-year Treasury yield is 1.52%. Its lowest level in many, many months. And I saw a tweet from, I think it was Carl Catanea over at CNBC here recently that suggested that last October, when a lot of government officials were saying that we have the economy that's the envy of the world and nothing can slow it down, it showed a screenshot of a CNBC chart of the 10-year Treasury rate, and at that time it was over 3%. That was just last October, meaning not even a year ago, we had a yield over 3%. In other words, we are down effectively half from where we were just 10 months ago. I mean, it's been remarkable to watch. So what that means is, on a relative basis, things like utilities and REITs have held up pretty darn well. In fact, we had a good conversation about that as well in my question and answer session class here earlier today for those of you that end up watching that recording. And you can see that play out right over here. This is VNQ. This is our Vanguard REITs chart that we're looking at here. And you can see that REITs were up nicely today, 1%, as interest rates plunged yet again, and REITs are up there in the upper half of their 3-month chart as opposed to the bottom half like you'll find a lot of the other sectors that are out there. You'll also note that preferred stocks have had a nice little bounce here recently, and remember, we don't talk about preferred stocks a lot, but they are oftentimes viewed as bond-like proxies, and so when interest rates do fall, they have a greater tendency to rise than to fall, and they are playing that part reasonably well right now. One of the areas within kind of fixed income space that's not doing as well is junk bonds. But remember, we've had this conversation a number of times over the last year or so as well. Junk bonds are not really responding to interest rates so much as they are responding to what's happening with oil prices. Junk bond market right now is filled to the gills with a lot of junky oil stocks. Remember, it's the companies that are on the brink that need to raise very expensive capital, and sometimes they're forced to raise high yield debt in order to do it. So if you look within the JNK, you're going to find a lot of those oil and gas related names that are kind of on the brink right now. And so you'll find that they don't really track the same way that government bonds would, or preferred stocks or foreign stocks. They're going to do a little bit better as the risk on area within the fixed income market, but they will really excel when you start seeing the stock prices of a lot of those oil and gas stocks holding up a bit better. So notice that the price of the junk bond chart here looks somewhat similar to the chart of the crude oil chart down below here. So anyway, a lot of interesting things going on here recently to talk about from an intermarket analysis perspective. But let's go ahead and mosey along now to the foreign stock markets. This is chart 4F. All right, so as we look at this, it's a clean sweep for the bears, meaning that every single one of these charts is pink. When I was with you here just 2 days ago, that was not the case. You did have more pink charts than green ones then, but it just goes to show you that things have not improved in the last 2 days. In fact, they've gotten a lot worse. Some of them considerably so. With Israel in particular, Israel has completely fallen apart the last 2 days here. This thing looked reasonably well as recently as just last week. We were above that rising moving average then, and boom, they just took it out. And that thing has fallen significantly. We actually have a moving average that is red on Israel now as a result of that violent move lower there. So if you look at these charts, every single one of them now, all 12 of them in front of us, have a red moving average. Not only do they have red background colors telling us that we have bearish intermediate postures on the market forecast technical indicator, but all of them have their path of least resistance to the downside if you are to believe the 30-day moving averages. Now, some of them have gotten to extremes, so don't forget that side of the coin as well. There is a possibility that things have gotten so bad that it's good. In other words, we're starting to get cluster signals here, as an example, on Brazil, which the last oversold cluster signal worked like a charm. You can see that the last one was over here on May 17th, and that would have been a perfect time to be buying it over the last couple of months. On the other hand, you start looking at something like United Kingdom down below, which also has a cluster here today. This one did have a cluster back at the end of May as well. It just didn't work as well as what happened there with Brazil. Yes, we got a reversion to the mean type of a rally, but it really didn't progress anything beyond just a couple of weeks worth of improvement, and eventually started falling further. Now, part of that is probably all the talk around Brexits and different things that is unique to the United Kingdom, but nonetheless, that one did not work out as well. You also have a cluster showing up here all of a sudden on Germany. And so, again, some of these places, even Russia's getting a cluster here today. So some of these places might be due for a little bit of an oversold type of a bounce, but until we see legitimate evidence of, base building taking place on the charts, you don't want to trust them any more than you can throw them. Maybe they're good for a quick little pop here or there on a 1 or 2 day basis, but until we start seeing legitimate bottoms being formed, it's going to be tough to trust these other areas of the globe right now. Let's go ahead and now take a look at the United States here at chart 4G. All right, so as we pull this one up, things are a little bit better here because at least we have two green charts on the board. It's not a clean sweep to the bears, and those are the two that I mentioned just a moment ago, which is utilities and REITs. This was the conversation we had earlier today in my classes, distinguishing the traditional dividend growth stock versus your utilities versus your REITs. How are they all interest rate sensitive, et cetera, et cetera. So we kind of broke down the various sectors out there, and we talked about healthcare, we talked about staples, we talked about utilities, we talked about REITs. And utilities and REITs are the ones that are most closely linked to that bond-like proxy, which is why they are the most interest rate sensitive. So you'll notice that both of them actually look reasonably strong right here. Both of them have a background color that is green. Both of them's price action is close to 3-month highs. Think about that for a second. Stock market's just been punched in the face, and you have 2 out of the 11 sectors that are actually on the brink to breaking out to new all-time highs. That is not all that normal, but it's a sign of the times and what is driving price action within the stock market right now. And of course, that is interest rate sensitivity and all the talk about the inverted yield curve yesterday and all that jazz. In fact, a quick reminder to those of you that are premium members here, remember, you can pull up chart 4J in this case to access the yield curve, and that'll allow you to access not only the all of the trends up above here, but it'll also show you the 210 spread down below here. Now, one thing that's interesting to me is when I was in class today, I was showing this exact screen, and the blue line was actually touching the pink line. So it looks like we did have a little bit of separation there, a little bit of a widening of that yield curve. Remember, these are monthly candles we're dealing with here, so it's not going to be as precise as being able to show you what's going to happen on a day-to-day basis. But nonetheless, there is just a little bit of wiggle room there, 10 basis points of separation between the 2s and the 10s, whereas yesterday there was actually that inversion for a brief amount of time. So a lot of people concerned about that, rightfully so, as inverted yield curves have usually suggested that a economic recession is on the horizon. But you do have to keep in mind that oftentimes there's a delay of at least a year between the time that the market gave you the inverted yield curve signal before the recession actually took place. So it's not necessarily a sell everything you have type of a sign, but that does seem to be how the market interpreted it yesterday, if you were to believe the price action. So we'll see if this time is different or not. But of course, that is what is concerning a lot of folks. And coming back on over here to the chart 4G with the sectors, that's why you're seeing the utilities and the REITs hold up better, because as the government treasury yields go lower and lower and lower, the dividend yields provided by utilities and REITs are looking more and more attractive, and so they're able to kind of maintain their strength a little bit better. And it's not as if staples have been doing poorly. I mentioned Coca-Cola before. Coca-Cola actually looks reasonably strong right now. That's the chart of Coke right there. If that's not a solid looking trend trade, I don't know what it is, right? That's a good looking chart right there in the midst of what a lot of people would feel is a market that's falling off of a cliff right now. So there are select names out there within the more defensive areas that are holding up a bit better. But if you get into the more cyclical areas of the market, you're struggling quite a bit more. I mentioned the financials as being the opposite of the utilities and the REITs. In an interest rate sensitivity type of a conversation, most banks and brokers do poorly if interest rates are falling, which is exactly what we've been seeing here in the last few weeks. But we do have at least maybe a little glimmer of hope there, a light at the end of the tunnel, so to speak. We do have an oversold cluster signal here on XLF right now. Note that the last time we had one of those was back here at the end of May, and that worked beautifully. So if you've been looking for values within the financial stock space, perhaps now you'll be able to sniff some out. I've been noticing a lot myself that have fallen very, very quickly, and their yields are getting nice and enticing right now. So perhaps this is a time for those of you brave enough to be contrarian to step in, buy a couple of those financial stocks that might have solid balance sheets and long histories of dividend growth out there. All right, so with that out of the way, let's now get into our trade application. Oh, before we do that, I just wanted to say thank you to those of you that clicked like. I didn't quite get to the 100 that I'm shooting for when I'm doing these videos. So remember, we basically give you a one-question survey. Did you like the video? Do you want us to continue to do them? If you do like the video and you want us to continue, all we ask you to do is click the like button on Twitter. That's it. Pretty easy. If you don't like the video and you don't want them continued on a daily basis, don't click like, and we'll get that message as well. So thank you to those 92 of you that did that for me since Tuesday. And remember, David's got his very popular technical analysis class coming up tomorrow, and that is one of our classes that's available for those of you that want to do the 7-day free trial with us at Market Scholars. Come over here to our pricing table if you want to learn more about that. But I look forward to seeing what David has to say tomorrow during that class, especially considering all the crazy market volatility we've been going through here recently. All right, so let's go ahead and get into our trade application example now. I'm going to pull up chart 4A, and let's just pull up ticker symbol AAPL. And I'm sure the vast majority of you know exactly what that is. It's Apple. Well, something happened here with Apple today. It changed from a bullish posture to a bearish posture, as you can see by the background color of the chart. Not only that, but we pushed lower from a price perspective. Remember that the stock market was up today. Apple is one of the 3 most important companies in the S&P 500, yet Apple was down 0.5% today, so a little bit of relative underperformance there. You'll also notice that another thing that changed today is the moving average color changed from yellow to red, suggesting that the moving average is now tilted slightly lower. Now, for all intents and purposes, that's largely flattish there, but it is true that price is below even what you might deem a flattish moving average, or if you would call it a downward trending moving average. Either way, it's not a great sign when the market was trying to bounce today and one of the most important companies on the planet is struggling to do that. You'll also see down below here with our volume candles, we've had a lot of aggressive volume days here recently. Remember, this is determining whether we have 1.5 times average volume when you see these black arrows within the volume candles. And you can kind of interpret whether the action was bullish or bearish by determining whether we have more red or more green within those candles. Now, it's pretty obvious that all of these back here were interpreted bearishly. This most recent one was probably interpreted bullishly, so we'll give them credit for that. But it does look like a lot of people have opted to be sellers of Apple over here more recently. So let's go ahead and do a bearish trade on Apple here. I'm going to do a bear call spread. So I'm going to pull up the trade tab, and I'm going to come on over here to the contracts that end on September 6th. These are the ones with 22 days left until expiration. These are weekly contracts I'm dealing with here. For some reason, my memory suggests that Apple usually has a big event in September, and so I don't want that to mess with our trade. So that's why I'm opting to go with the contracts that end the first week of September as opposed to do the normal monthly style. But obviously you can choose to do the opposite if you so desire, but in this case that was kind of the reasoning behind that. So this will be a little bit of a shorter trade here with only being in it for 22 days. But as I come on over here to the delta, and I look at the call side of the equation, I do see that we have a delta spot on 30 right there. And oftentimes that's the strike that we look to sell. So I'm going to right click and I'm going to go to sell vertical. That'll load up our trade down below. Notice that it's showing us that we're selling the 210, we're buying the 212. Actually, this is the 212.50 to be precise. So that's a $2.50 wide spread that we're dealing with there. Now this is going for a credit of 69 cents right here. And remember, we're trying to get a 30% return on risk at a minimum. So if we were to click on confirm and send, we can kind of do that calculation real quick here. Just basically take whatever your max profit is. So we'll just do one contract here, just keep it nice and simple. So $69, hang on. There we go, $69 divided by the max loss, which in this case is $181, means that our return on risk is 38%. In other words, it's more than 30% right there. In fact, it's enough over 30% where perhaps you could even stretch it out a bit more. Let me just check that real quick because now I've piqued my own curiosity there. Let me go back on over here to the 212, right click and go to sell that vertical. 57 cents. That might be knocking on the door. Let me check this out. So if we were to sell the 212.50 and buy the 215 instead, we would get $57 of credit. Divide that by 193 max loss. Yeah, we're right there. You round up, it's actually a 30% return on risk. So I'm actually gonna change strides here mid video. I wasn't planning on doing this one, but we're actually gonna do that. Give ourselves a little bit of extra wiggle room, and remember, we should be a little bit more loose with our 30% standard anyway, because we're only gonna be in the trade for 22 days. So I am gonna change here what I initially thought I was going to do. We're gonna give ourselves an additional $2.50 of upside wiggle room, because remember, when we're doing a trade like this, what we're effectively saying is we do not want the stock to go above our break-even price. So this is a stock that closed today at 201.74. And so we don't want it to go up and above 213.07. So let me show you on over here real quick. 213.07 will bring us up at about this level right here that I'm pointing at on the chart. What's nice about that is it gets us up and over this candle right here. When I was looking at the other spread, our break even was right up at the top of that candle. So it's kind of nice that we can do this other one where it requires us to be wrong. What is required of that is for the price to go above this big candle over here. So if you believe that there was a big seller sitting up at the top of that level, then this spread should be protected as a result. So let's go on over here, click on confirm and send, and ship that off to the market. We'll see if we can get filled first thing in the morning. All right, well, thank you for joining me here tonight yet again. Remember, if you got value out of the video tonight, please go over to Twitter, click like. You can do that right on our website if you want to. Otherwise, I'll have it pinned to the top of my Twitter timeline as well. But as a kind of a summary or a recap, we remain in a bearish posture right now. We didn't get much of a bounce here today, so if that's all the bulls had, that was kind of a whimper. We'll see if it takes us further here with any positive news that might come out overnight. But as of this moment in time, it probably pays to stay a little bit hesitant. There are going to be some signs of potential bounces, like I showed you there with the Russell 2000's oversold cluster signal. So there is that possibility as well. But right now, we are still in precarious times. So it probably means that you should stay nimble, smaller position sizes, etc. So David should be back with you tomorrow. In fact, I think he'll probably try to do the live version of the video again for those of you that are premium members of Market Scholars about a half an hour before the market closes. So keep your eye on your email if you represent one of those premium Market Scholars. And I'll see you all next week. Take care, everybody. Bye-bye.